pull apart this gaslighted misinformation that the PBOC has stopped buying gold in May. Now, taking a leaf out of the Fed's playbook, the PBOC assisted in disseminating the narrative that following 18 months of official central bank gold buying, they paused buying completely. Wow. I mean, you can imagine that suited them very well. And as these reports jived with a retail slowdown in China, due really to the highest on record renminbi price gold, the Fed also jumped on the narrative bandwagon to cap and short sell gold, seeking to cover off some deeply underwater derivative bets. Now, to this end, having such deep pockets to hunt out spec longs, to that end, they have succeeded. However, while official gold purchases did stop in May, based on supply and demand flows, as we mentioned in June, our liquidity providers had already been countering this narrative. Now we have empirical evidence that monetary gold purchases actually increased. Now, the PBOC does not buy gold through the SGE conduit, and as any savvy buyer would, they accumulate gold well in advance of announcing their official purchases. However, monetary gold does not need to be reported, and given these transactions are primarily conducted in dollars, euros, Swiss francs, pounds, in the form of 400-ounce 995 bars, and that there are 47 customs entry conduits and 4,000 customs clearance control stations, by design, it's impossible to track the scope of all the PBOC's monetary gold purchases.
Andrew Maguire has been hearing that Beijing is in a mad dash to accumulate as much gold as possible before the BRICS gold-backed currency launch and the anticipated sanctions and duties expected after the U.S. elections. There's also talk that, quietly, over $3 trillion in mostly dollar-denominated shadow banking reserves, something former US Trade and Treasury official Brad Setzer flagged, are being covertly swapped for bullion gold, silver, artisanal gold, D-bars, direct mine investments, you name it. Jan at Gainesville Coins has apparently been keeping tabs on this and noted that 353 tons of 400-ounce bars were shipped to the PBOC in May alone, which might back this up. And these gold purchases, they're likely not even on the PBOC's books because they're classified as monetary gold. Just like what happened when $300 billion in Russian central bank reserves were frozen by the West in 2022, leading the UK to ship massive amounts of 400-ounce bars to China at the same time. Word is, the PBOC's gold buying ramped up right after the EU froze 260 billion euros of Russian assets on May 21st, and now, with the PBOC stepping up its gold purchases, the global supply is tightening. Jan thinks this might explain the drop in retail demand in China, which sounds plausible. As for the de-dollarization process, there's been chatter that China isn't about to hurt itself by dumping Treasury bonds for gold, even with the situation in Taiwan.
And just as unreported PBOC gold purchases exploded when 300 billion in foreign exchange reserves from the Russian central bank were frozen by the West in 2022, due to the war, notably the UK began exporting 400-ounce bars to China in huge tonnages at exactly the same time. That's what's going on now. It's no coincidence that the PBOC gold purchases stepped up significantly after the EU froze 260 billion euros of Russian assets on the 21st of May, really essentially stealing, confiscating an ongoing 3.5 billion generated by these assets to back a 50 billion loan to Ukraine. And given the PBOC is stepping up its purchases, it's going to tighten up global supply, and the early stages of this is really sucking supply to retail buyers in China, which actually, Jan assesses, could actually be a reason for the downturn in retail demand, which makes sense. Now, as subscribers will know, we've been tracking the ramp up and potential scale of the de-dollarization process, And why Taiwan escalations aside, it really doesn't suit China to shoot themselves in the foot by invoking the nuclear option of openly dumping treasuries to buy gold. But looking at the bigger picture, which backs up how central bank demand has been hidden by the Fed's recent efforts to cap gold into literally billions of dollars of deeply underwater OCC OPEX bets. Remember, the Office of the Comptroller. These are FX bets that sit outside of the futures market and on top of the futures market liabilities. And the liquidity providers estimate they aggregate to around probably $1,900 per ounce. Now, we may have seen that rise to $2,200, but that's not 100% clear yet. Now, the Bank of International Settlement swaps have, during this last period of time, have increased by 7 tons to 116 tons. So let's put that into context. This 7 tons represents over $500 million of real bullion borrowed by the Fed to finance their capping efforts. And while this bullion does not physically leave the Bank of International Settlements site account, on paper, this loan bullion is leveraged by 96%, creating 670 odd tons. That's 52 billion of COMEX supply. Now, that's a hell of a lot of velocity there. Now, the Fed is the only central bank that has not been able to exit the historical naked short bets against gold. Every ounce of the current outstanding 116 tons of gold borrowed from the Bank of International Settlements by the Fed will have to be paid back at significantly higher prices. Now, if they had managed to offset any of these bets into the $600 physically driven rally from 1900 to the recent test, very close test of 2500.
Andrew Maguire stated that if the Fed had managed to offset any of their bets during the $600 rally from $2,900 to the recent near test of $2,500, they wouldn't have needed to borrow more gold from the BIS to mark those billions of dollars of OPEX bets to market on July 25th. He pointed out that the Fed had to face up to T+2 NSFR-compliant delivery obligations, meaning that once they tagged that spot price, delivery had to happen within 2 days. Now, with T+1 in place, the delivery time has been reduced to just 1 day, a change made by the BIS because they're now competing with the Fed for a liquid gold price. Maguire also mentioned that the Fed had to go into the market and buy gold at market prices, driving that $450 rally in gold almost without a pullback. Addressing the current situation, Maguire noted that the Fed has once again been forced to cap gold into these increasingly wrong-footed technical NSFR-compliant FX multibillion-dollar OC bets, triggering fresh, much higher central bank bids around $2,400. He explained that the Fed will need to deliver at the BIS as each monthly FX bet matures. Maguire emphasized that, based on estimates from liquidity providers, the size of the Fed's FX bets suggests they will have to buy back the borrowed gold at even higher prices, potentially driving the price to $3,000 per ounce or more. He noted that central bank buyers are saying, "We're buying physical and allocating it," and he expects more of this to come to light as the year progresses. Maguire concluded that official gold purchases are likely to accelerate, tightening global supplies and pushing prices higher, with other central banks potentially following suit.